Well, howdy there, folks. It's a three-piece here today. Three videos for me to react to. First one is we have an easy money stock flying to the moon here today, up around 17 percentage points, and that is Target. Target is flying. So a couple of videos I want to react to here. Here's why Target stock is moving higher. We're going to react to that one in this video. Target earnings beat show consumers are still spending. I thought we'd react to this video. I'll share my perspective and opinions on that one. And last video I want to get up into here is maybe the most important video of the day, which is around wholesale prices and what's going on there. And if you weren't already convinced inflation is donezo for 2024, yeah, after you watch this video, you will be 100% convinced, okay? Now, Target's having a massive day. Yeah, this is a stock that's very beaten down, and this is a stock that has just been, if you've been buying the stock for the last few months, it's been very easy money. I mean, Target already was very attractive, kind of in this 140 to 160 range, but then when it dropped down to like $110 over the past few months, that's just silly pricing. I mean, just absolutely silly. When it went under 120, like, come on, man. Easy money. And nonetheless, folks, we are flying on this one here today. And it's bringing up even stocks like Elf. Elf's up over 5 percentage points here today. It's even bringing up other retail-related stocks. You look at Revolve here today, up almost 4%. Foot Locker's up almost 4%. Even bringing along a stock like Honest. And to be honest, it's not like it's a great day in the market necessarily. The Dow's up 88 points. The Nasdaq's up 0.1%. And the S&P 500's about flat today. And so Target making this move on a day like today is absolutely pretty monumental in regards to this. Now, in terms of me grading their income statement, here's what I gave it a grade for. If you don't know, I grade massive quantities of income statements every single earnings season. Like, look at this. This is all in the private group. I just, circle what's good, what's bad, so everybody can learn exactly how to judge income statements, bad, good. Look at this. It's just ridiculous. But anyways, if we look at Target, my latest one here, I graded them with a B+. The only bad thing Target has going, and the only reason this is an A income statement, is their revenue. That's why it's a B income statement, is their revenue is actually down, over $1 billion on a year-over-year basis. But their cost of sales was very impressive. Their cost of sales, they brought that down way more, and I mean way more than revenue was down. And so what does that end up meaning? Well, if you can bring down your cost of sales way more than, your revenue was down, then that means your operating income is going to likely be pretty darn explosive, especially if you can keep your SG&A in line. And they were up slightly year over year in SG&A, but they kept it pretty in line, especially considering the wage environment we're in right now. So operating income for Target went all the way up to over $1.3 billion. That's versus about $1 billion in this same quarter last year. So operating income was up nearly $300 million while revenue was down for the company. That's pretty damn impressive. Net interest expense was also down for the company, and they had net other income that was up slightly more for the company overall. Earnings before income taxes was in a spot right now that I would call very healthy. Over $1.2 billion in earnings before income taxes versus $909 million in the same quarter last year. As far as basic EPS, 210, diluted EPS 210, net earnings 971 versus 712. So outside of the revenue, this was a very impressive income statement overall there. And so good to see Target back on the right track, folks. Okay, good to see Target. Now we're about to react to these videos. Appreciate everybody joining me as always. Thanks so much for being here. Thank you for being subscribed. New all-time high subscribers in the history of the channel. And we got the massive sale coming. It's 8 days away, folks. The Black Friday sale. If you haven't already signed up to get that deal when it comes out on Black Friday, what the heck are you doing? Okay, it's the best deal you're going to get on Black Friday. It's nothing better than this. Okay, Become a Master Stock Market, my #1 course ever, plus the ability to see the stocks I'm positioning into and out of in the Patreon portfolio through Fidelity Investments there. Plus you see exactly how I diversify portfolio. Like, it's going to get no better than that, folks. So make sure you check out the pinned comment down there, enter in your info. I'll send it over on Black Friday so you have access to that. All right, guys, let's get into this.
Cowan's Oliver Chen, because we want to talk a bit more about Target. He has a price target of 161, outperform rating on the stock. Oliver, I mean, traffic declined, but investors don't seem particularly concerned with that, perhaps more taken with that margin number that fueled a far higher earnings per share and earnings number than had been anticipated. Are investors getting it right, in your opinion?
Yeah, there's a couple things, David. Great being here. The top line was better than feared. So comps came in at negative 4.9. Wall Street was looking for negative 5.3. Also, David, the second point, SG&A, those margins were better.
His price target is $161 on Target. Do I think that's fair? So Target right now is a little under $130. Target's been a stock that's been over $200 before. So Do I think that's a fair price target, 161? I would say that's a very fair price target. I think that might even be a little bit conservative. I think there's a potential target goes more to 170, 180 over the next 12 months. I think that's a real potential. So 161, I think, is very fair. Very fair. I think somewhat conservative estimate for where Target's going over the next 12 months.
To upside. Sarah's right. Expectations were fairly low coming into this quarter. The PE multiple was about 12 times. That's in contrast to Walmart at 24 times.
Yeah, if you want to know why Target stock is going insane, and I tell you guys, this is something very important that you got to understand how the market works and the mechanics of the market work. When you have a story that goes from, disaster to bad, massive move up in the stock. When it goes from bad to good, massive move up in the stock. When it goes from, from bad to okay. When it goes from okay to good, massive move up in the stock. When it goes from good to great, massive move up in the stock. Same thing works on the downside. If you have a story that goes from great to just good, move down in the stock. From good to okay, move down the stock. Then from good to bad, massive move down the stock. From bad to disaster, huge move down the stock. Okay, and so Target's at that stage of like getting to where things are okay now. At this point in time, if they go from okay to good, where they get that top line back in the right direction, then we're talking about a next massive move in the stock. They can go from good to great, where their numbers used to be. Then we're talking about another massive move up for the stock overall. That's the game of the stock market, and that's when you get these insane moves.
Lots of caution still, but the stock had been under so much pressure, and these better than feared results are part of what moved the stock higher this morning.
Is this, you mentioned, of course, being under pressure. That's been the case for quite some time, and it's been any number of different stories, whether it's boycotts related to LGBTQ, whether it's shrink, particularly theft, and on from there. Is this the beginning of a new and more positive story for Target?
Well, we hope so. However, consumer discretionary at large is under pressure. And keep in mind, Target's about 20% food, Walmart's 60%, the number one grocer. Food, essentials, beauty has been working very well. On the other hand, apparel, home, hardlines, that's about a third of the business at Target. That's been running down high single digits. And inflation is really weighing on consumers. In addition, student loan repayments are a key factor. Some of the offsets are there are $700 billion of savings on the sidelines with consumers. Also, unemployment is low at 3.9%. Furthermore, there's still nominal wage growth, which is running at 5%, and inflation's running closer to 4%. So there's puts and takes, and Target called it a consumer tug of war. I think that's what's happening in terms of a consumer that wants joy and emotion. However, this consumer is experiencing a fair amount of pain with inflation and being very considered in how they think about purchases. Bottom line, we see a consumer that's very focused on needs versus wants, needing tons of newness, needing promotions. Our top ideas are Ulta and Walmart.
So Walmart over Target, let me be very clear about this, okay? That is very, very backward looking. Very backward looking, okay? You got to think of where the consumer's headed here, okay? If anything, the consumer is headed toward a much healthier place overall, right? Inflation's no longer an issue. It's not going to be an issue in 2024, right? That's good. Real wages are actually starting to uptick for the first time in quite some time. That's good for the consumer. So if anything, the consumer is going to be in a better spot in 2024 than they certainly were in 2023, which bodes much better for a company like a Target versus somebody like a Walmart, especially when you look at Target's valuation versus Walmart's valuation. If this was 18 months ago or 24 months ago, it's a whole different story, because you were talking about at that time going into a very high inflationary environment where the consumer is going to get pinched. And then guess what? If the consumer is very price sensitive, Walmart's always going to win that. It's just bottom line. Like, Walmart's always going to win. Like, you want a box of Kraft macaroni and cheese. Is it cheaper at Target or Walmart? Like, it's almost always going to be cheaper at Walmart, right? You want you need some AA batteries. Cheaper at Walmart or Target. So it'll almost always be cheaper at Walmart. So if the consumer is very price sensitive, like, Walmart's going to win that proposition. So I just think in my personal opinion, he's a little backwards looking in regards to kind of judging Walmart versus Target. And also, Walmart's valuation is not attractive at all, whereas Target is.
All right, Sarah, how does it set up Target for the holiday season? When I was talking to Michael Fidelki, the CFO, he was emphasizing that Target is embracing newness Even though, inventory is coming down, they're really investing. Fenty by Rihanna. They now carry the beauty product.
Who's that? Is that G up there? Is G flying around? Hey, Fenty Fenty Beauty is now at Target? That's huge. That's huge. No, that's where Target just wins over Walmart any day of the week. Like, nothing about Walmart is cool. Like, nothing. Literally nothing. Target is cool. Target's always been cool. They always had the coolest brands. That's why people want to shop at Target. There's a difference. People want to shop at Target. No one wants to shop at Walmart. You go to Walmart because you need to go to Walmart. You may be in a tougher financial position, or maybe that's the only store around you or something like that, right? Target's a whole different ballgame.
Which are really doing well, just as an example. And I wonder if that's enough to move the needle for them in what appears to be a pretty tough macroeconomic environment for holiday spending for a company like Target.
Ask any female, you want to go to Target, you want to go to Walmart? Come on, man. Every single one's going to say, I'd rather go to Target. Put them on a lie detector test. There's not one that would rather go to Walmart over Target. Not one. Doesn't exist.
Yeah, you're right, Sarah. I mean, if we're excited about Barbie, Legos, Pokemon, and beauty continues to work. The consumer does put beauty almost as an essential in terms of that being so important for self-care. The other thing that's happening at Target, a lot of focus on the conference call was on opening price points and value. Value will be a key theme in making sure you have low accessible price points. This will be a great gifting season, but unfortunately, we've had warmer weather, we've had volatile store traffic, and we've had a high degree of promotions. Promotions are still under control, but that's really something to watch. Apparel is a watch-out category, especially because it's been warmer. We're hopeful for toys, and we're also hopeful that Target is really indexing into these everyday low prices, low access price points and promotions to drive a holiday. But it'll be pretty choppy.
I was even thinking about myself as a kid. I was thinking about, like, did I have a preference of Target or Walmart? And hell yeah, I wanted to go to Target as a kid. Like, freaking Target all day over Walmart. Are you kidding me? Like, 100%. And I was even thinking about, like, I was remembering back in the day, like, sports cards were really big when I was a kid. And I remember, like, where did we go for that? It was Target. Target used to have a crazy selection of different, like, sports cards back in those days and whatnot. And, my dad, we'd go down there and whatnot with my brother and get a bunch of sports cards. He was really into that. So, all right, next one up here. Target earnings beat show consumers are still spending. This should be an interesting one.
Much more. Sylvia Jablonski, CIO and CEO at Defiance ETF. Sylvia, as we had said, positioning in the stock, expectations were very, very low. What do you make, at least initially, of this quarter for Target?
Good morning, and great to be here with you today. Well, I think that 210 number is a great beat, right? 210 versus 148. So I think that they certainly exceeded the very low expectations. Target came out in August and sort of set a very low bar themselves on what they expected into the future, and it looks like they beat there. So I think it's a good sign. I think stocks like Target actually provide us a glimpse into the health of the consumer. And then you think about what happened with that inflation read yesterday. Price of oil has gone down a little bit. Perhaps there's been some ease, and that led to additional spending for Target. And then I think they also have some good tailwinds coming forth. November, December, we're going into the holiday season here, so they probably get another good quarter. I don't know long term about that.
Okay, so how am I feeling about holiday season and holiday shopping? Do I think it's going to be a strong holiday season, a weak holiday season? My personal opinion is I think we're going to be okay this holiday season. I don't think it's going to be some booming holiday season. I do not think that at all. Because I think the consumer still got hit really hard this year, and I think we're kind of on the comeback next year. I also don't think it's going to be a disaster by any stretch of the imagination. If anybody's expecting a disastrous holiday shopping season, I don't see that. I think it's going to be okay. And the good news is expectations are pretty low for this holiday shopping season from Wall Street. And so that sets us up, once again, for a pretty good situation. I love when you go in and the expectations are low. Then you just come in with something decent and boom, you go flying, right? And look at Target. Target came in with revenue still down $1 billion plus year over year, and yet the stock's up 16, 17% here today, right? That's, at the end of the day, they came through, man. They came through and it was better than feared.
The conversation about locking things up, I mean, for me, 99% of the time I leave if I have to wait more than a couple of minutes. So I do think they have to sort out sort of the theft issue and the convenience issue. But longer term, consumer has wages and looks like they're still spending them.
We had a data point yesterday that really sent stocks off to the races on this notion that a soft landing is all but assured at this point. In that sort of environment, do you want to bet on a Target over a Walmart? The spread there is significant, simply because Walmart has just more exposure to consumables, things that
you don't want to bet on Walmart over Target over this next 12,
that right mix.
18 months.
In a soft landing environment under that scenario, is that a better target environment than Walmart?
It probably is a better target environment. You're talking about sort of staples versus discretionary. And if the consumer remains strong, they have, liquidity, they have cash, and again, the prices of oil are going down and there's some ease in inflation with the price of food and things like this, then I think discretionary spending and sort of their willingness to spend goes back up, and perhaps you get a little bit of tailwind with a Target. But, it sort of all depends, right? What we're worried about is what the Fed does in the background. There's always this sort of risk of a head fake, and having a couple of good reads, does not make policy for the Fed, as we know. So we do have to sort of keep an eye on what happens in coming months. But I think it's, certainly a good sign to see that type of CPI number and the direction of the 10-year and things like this.
Wanted to ask you about chip stocks. SMH hitting a new all-time high in yesterday's session. Really, really strong day, really strong year for semi stocks overall.
And if you want to know another stock that's set up for an absolutely massive, epic explosion of the upside, if they just come in with, let's just call it the next few quarters, just something decent, and they can revive that business model, and it doesn't even have to be amazing. It's just decent numbers. The stock is Foot Locker. Foot Locker is another one of these stocks that's positioned, end of the world, just, stocks trading at, recently over the last couple months, that stock's been trading at, 10, 20 plus year lows. Like, it's been absolutely wrecked. And so that's another one of those that if they just come in with something decent, you see that stock fly 20, 30% in a day. So Mary Dillon is setting herself up pretty good for 2024 for Foot Locker, I'll say that. And now she's just got to come through with the numbers.
You've been bullish on AMD and Intel. Those are two names specifically that David Tepper's Appaloosa has cut. Michael Burry of Cyan Asset Management has also put positions on chip stocks. That could be a hedge against the long. But just talk to me about where we are valued right now for this point in time.
Right. So I actually love chip stocks. I think that AI and, kind of quantum computing, supercomputing, machine learning, all of these kind of innovations are the next super cycle of technology in the next, 5 years or so. And it's tangible, right? We have electric vehicles already. We're already seeing Microsoft deploy some AI. So I think these things are actually happening. It's less hype, a little more action now. But I like AMD. I think, there's the NVIDIA CEO talked about the $1 trillion conversion in data center. They own 90% of it, but AMD owns 10% of it. They're, kind of growing into soaking up some of the percentage from NVIDIA. They have some opportunity there. Revenues are expected to grow 9%. Gaming is starting to pick up a little bit again. They're in Xboxes. Again, they're sitting in things like electric vehicles. Intel, I think, is a turnaround story. They finally had a decent earnings read. They're, kind of finally on track to generate revenues as well. So I think when you have this kind of like running, what are chips or the components of AI and machine learning, the future remains there in terms of an opportunity. And I know that they've soared, but I think, if you're thinking of holding this for another 5 years or so, this is going to pay off.
Yeah, so in regards to chip stocks, I view those as I'm not super excited about them, but I'm also don't think they're going to necessarily crash. They're easy shorts. I mean, if we go back 2 years ago from today, easy sells, easy cash outs, or be in a situation where you're shorting those stocks, right? I think a year ago, easy buy opportunity. And now as I sit here today, I don't really view them necessarily as an easy buy, but I also don't think they're great stocks to short or something like that right now either. I just think it's kind of like an okay time for semis over this next year or so, okay? Alrighty, next one up here. Wholesale prices fell. This is huge.
Rick Santelli, who's at the CME in Chicago.
Hey, fly your chopper somewhere else. Fly your chopper somewhere else.
PPI for the month of October, expecting up 1/10. Buckle
it's not
up.
A freaking airport,
down
dude.
0.5%, down 0.5%. That is a huge drop. You have to go way back to April of 2020 to find a smaller month over.
Two things. This is massive. Absolutely epically massive. Okay. First off, if there was anybody that was worried about inflation for 2024, this is just the last nail in the coffin. of inflation is not a problem for 2024. Who knows in future years, but not for this upcoming year, I can tell you that much. Second thing is, this is almost like a big recessionary type tell here, right? Wholesale prices being down 0.5% in October, that's kind of recessionary. I mean, the biggest monthly drop since April 2020, guess what? April 2020, the whole world was freaking shut down. The whole freaking world was shut down. So anytime you got a comp against April of 2020, no, okay, that is not good. So I thought this is a very important number.
Change, and that one happened to be minus 1.2. And if we look at what is going on with regard to ex-food and energy, unchanged, also significantly lower than up 0.3. Ex-food, energy, and trade up 0.1, half what we were expecting. Year-over-year numbers now. Final demand 1.3, a huge drop from 2.2. 1.3. That is the lowest level going back to July when it was 1.1. And if we look at 2.4, if you subtract food and energy, that's 0.3 less than we were looking for. You'd have to go back all the way to January of 2021 to find a lower number. Wow. And finally, ex-food, energy, and trade, 2.9. That is the only metric that's higher than we're expecting. We're expecting 2.8, and 2.8 was in the rearview mirror. We had several 2.9s. We had them in July and August. So food, energy, and trade is a little stickier than expected. All the other numbers are cooler than expected. Let's look at Empire, shall we? Empire expected down 3 is now 9.1. 9.1, that's the best level going back to 10.8, which was April. Now retail sales for October, down 0.1%. We were expecting a down number. That's less than the down 0.3% we were looking for. And we made it up in the revision from up.
So that means retail's a little stronger than folks anticipated.
That's up 0.9. If you strip out autos, it's up 0.1. So we could see that autos, of course, affected the equation a bit, and stripping them out turns it up 0.2 into a positive 1/10. Rearview mirror, 0.2 of a revision from up 6 to up 0.8. Strip out autos and gas sales, also up 1/10. The control group is up 0.2, exactly as expected. That follows a revision from 0.6 to 0.7. What's notable here is all the revisions for September were positive revisions. We see that interest rates aren't moving much. As a matter of fact, we are now a couple of 30 seconds higher. We look at the futures. If we look at what's going on, 448, we're at 446 on the cash market. 487 on Tuesday. We're at 484. So what's going on? Well, I think that part of this is yesterday we probably had a bit of an overreaction to CPI. Understandable. Not only in the U.S., in the U.K. they had a better than expected number. And how over their skis did they get? Get this, Joe. They auctioned off 7 billion pounds of 20-year notes. They received 93 billion pounds worth of bids. 13 times more bids than the amount of securities for sale. That is unreal, and it really does underscore that central banks were very punishing the notion that they're done. Well, it's a big party out there. Now, whether this holds true, we're still a bit of a ways from our 2% target, and PPI cooler numbers didn't really garner a lot of market activity like CPI. The other thing we want to point to is that are we going to ever pay more attention again to supply or to term premiums? They didn't go away. We've just changed our focus. You always trade the market ahead of you, but that certainly doesn't mean that there aren't issues ahead, especially issues when you think about how governments around the world are trying to control more of their economies. That should affect productivity. But at least for the moment, inflation seems to have struck a chord not only with our central bankers, but also investors, interpreting those as very positive signs. Joe, back to you.
All right, Rick. Very good. Let's get to Steve Leisman. He joins us now with more. We're seeing, Steve, kind of a muted reaction. Did we get it all yesterday from the CPI, which may...
Yeah, so if you're wondering why, the market's not reacting bigger, right? I mean, because that is pretty good news for us. Like, why is the market not reacting bigger? The NASDAQ's actually down right now. The Dow Jones Industrial Average up 0.4%. The S&P 500 up 0.2%. That's a pretty lame reaction. And the reason being is you got to remember what runs the stock market, right? Well, two things. Okay, first off, there's really two components to this. The first component of this is that I think is very important that everybody understands, okay, is everybody was already convinced after yesterday's numbers that the Fed's done. Okay, the Fed's not raising rates anymore. What happened right today is just more evidence that the Fed's done. They're not raising anymore, okay? And if anything, they'll cut at some point in time. And then if you're thinking about in terms of like if we look to the future a little bit, right? Inflation's not an issue, Fed's not going to raise, and everybody starts thinking, is the Fed going to cut? Now, my hope is the Fed does not cut in 2024. Why do I hope that? One is there's a lot of money on the sideline. I'd rather that money stay there so I can buy stocks for cheaper, right? Second component, why I hope the Fed doesn't lower, is right now you can get great returns from savings accounts and treasuries, right? 4 to 5%. So any sideline money, I can get 4 to 5% on right now, which is a thing of beauty, right? I love that. I absolutely love that. And also, obviously, if the Fed starts lowering rates in any substantial way, it's usually because the economy is getting devastated. And that's not obviously a great situation to be in next year. So if anything, I'd rather have the Fed not raise rates, right? But ultimately, what runs the market, right? It's the big tech stocks, the big dogs that have already been running. And so you look at a lot of the stocks that are performing phenomenal today, right? And these aren't big. These aren't going to move the market. Target, Elf's up over 6% for me today. Nordstrom's up 5.5% for me today. Revolve's up 4% for me today. Foot Locker's up 4%. Shopify, Fubo's up almost 3%. These stocks do not move the market. They just don't. Okay. If the market's moving, it's because of big tech. And if those ones aren't rallying hard, then the indexes ultimately just have a very muted reaction. And that's exactly what we see playing out here today, folks. Okay. So yeah, interesting times nonetheless. I appreciate y'all joining me as always. Thanks so much for being here. Thank you for being a subscribe. New all-time high subscribers in the history of the channel. Make sure you get access to my Black Friday deal. It's 8 days away, folks. Pin comment for access to that, and we'll send you over the deal either through your email or text it over to you when that deal drops on Black Friday. It's a 1-day sale. You do not want to miss that one, or you will definitely regret it because you'll be like, dang, I should have joined that Black Friday deal. So that's pin comment down there. Much love and have a great day.